you've been trading in the live market, you've probably noticed something really frustrating. You spot what looks like a perfect setup on the chart, you enter the trade, and then, within minutes, price hits your stop loss and takes off in the exact direction you were trading. Sounds familiar, right? I'm sure a lot of you are thinking, yeah, this happens to me almost every single day. But have you ever really stopped and thought about why this keeps happening to you over and over again? The biggest reason behind this is liquidity. Out of all the important chart reading concepts in smart money trading, liquidity is hands down the most crucial one. If you can learn to identify liquidity on a chart, honestly, nothing can stop you from becoming a profitable trader. Because here's the thing. Operators, meaning big institutional traders, they always target retail traders' liquidity before making any major move in the market. And if you can figure out which levels on the chart have liquidity sitting around them, instead of falling into their traps, you can actually ride along with them and make money. So in today's video, we're going to break down the liquidity concept from A to Z in full detail. We'll cover what liquidity actually is, where it forms on the chart, the different types of liquidity, the difference between internal and external liquidity, what a liquidity pool is, and finally, the most important part, how you can use the liquidity concept to actually improve your trading. So, let's get into it. Chapter 1. What is liquidity? So look, there are basically two types of participants in the market. On one side, you've got buyers, and on the other side, you've got sellers. Whenever a seller sells a stock, that's when a buyer can buy it. Meaning, one person has to sell for the other person to buy. And this whole exchange between the two is what we call trading. Now, until the number of buyers and sellers is equal to each other, no transaction can actually happen between them. Let's understand this with a simple example. On a chart, at this particular level, a seller has placed an order to sell 1,000 shares. But on the other side, a buyer has only placed a buy order for 800 shares. So what happens here is that only 800 shares worth of orders get executed, and the remaining 200 shares just sit there as pending orders at that level. In other words, there are more sellers here, but not enough buyers. That means there isn't sufficient liquidity available on the chart at this point, which is why the transaction didn't fully complete. And this is exactly what's known as liquidity in smart money concepts. There are two types of participants in the market. On one side, the biggest capital is held by big institutions that includes major banks and hedge funds. These guys manage not just their own money, but also the money of other investors. And on the other side, you've got retail traders like you and me who have limited capital. Now, these big institutions, or operators, they need retail traders' orders to get their massive orders executed in the market. For example, let's say an operator wants to sell 500,000 quantities of call options at a certain level in the market. But executing that many orders in one place isn't possible because there aren't enough retail traders buying call options at that point. So, what do operators do? They create some fake moves in the market. Retail traders see this and think, oh, the market is going up from here, and they start buying options. As more and more retail traders jump in, the operators get the liquidity they need to execute their selling orders. And then, boom, the market suddenly reverses. In simple terms, if you want to find liquidity on a chart, all you need to do is figure out where buyers and sellers are most active right now. Meaning, where are they doing the most buying and selling? Chapter 2. Where does liquidity form on the chart? Pay close attention to this chapter because it can completely change the way you read charts. See, whenever a retail trader takes a trade in the market, they always place a stop loss at some level to protect their position. Now, a lot of beginner traders don't realize that stop loss orders are actually the opposite side orders of their entry orders. For example, if a trader has taken a long trade, meaning they bought a stock or an option, their stop loss is a sell order. Because when price drops down and hits the stop loss, the system automatically executes a sell order to close their buy position. And if a trader has taken a short trade, meaning they sold, their stop loss is a buy order. Because when the stop loss gets hit, a buy order executes to close their sell position. Now this is really important, so let me explain it one more time carefully. All the buyers who have taken long trades in the market, their stop losses are sell orders. And all the sellers who have entered short trades, their stop losses are buy orders. Now, when a large number of retail traders place their stop losses around the same area, a massive number of pending orders pile up at that spot. These pending orders are what we call liquidity, and operators target exactly this liquidity. Now let's go into detail about exactly which areas on the chart liquidity mainly forms. Area number 1, near swing highs and swing lows. If you don't know what swing highs and swing lows are, let's quickly cover that first. When price is moving up and stops at a certain point before coming back down, that highest point is called a swing high. And when price is moving down and stops at a certain point before turning back up, that lowest point is called a swing low. Now, whenever the market is in an uptrend making higher highs and higher lows, there are buyers' stop losses sitting below every single swing low. Because the retail traders who entered long trades near these swing lows have their stop loss orders placed below these levels. Most retail traders place their stop loss right below the recent swing low. That's why a large amount of sell-side liquidity gets generated in these areas. Similarly, in a downtrend, there's buy-side liquidity above every swing high because retail sellers have their stop losses sitting there. Area number 2, near equal highs and equal lows. Whenever price gets rejected from the same level multiple times on a chart, equal highs or equal lows form there. Like, price is getting rejected both on the upside and downside from the same levels repeatedly. Now, these areas are operators' absolute favorite targets, because at these spots, a huge number of retail traders look at the chart and think, hey, there's a strong resistance or support level here. So they place their stop losses just above or below these levels, which makes these areas the highest liquidity zones on the chart. Operators know that retail traders treat equal highs as resistance and equal lows as support. That's exactly why whenever operators need liquidity, they target these areas first, because there's a massive number of retail traders' stop loss orders sitting in one place. Area number 3, near support and resistance levels. These are the most commonly used levels in trading, and because every single trader, whether beginner or experienced, learns support and resistance first, there's the most trading activity around these levels. Whenever price tests a support level, a lot of buyers place their stop loss below that level and enter long trades. Their thinking is that if support breaks, the market could drop further. So placing a stop loss below support becomes second nature to them. Similarly, at resistance levels, sellers place their stop loss above and enter short trades. Because of this, a massive number of stop loss orders pile up around these levels, and liquidity gets generated there. And operators know this very well. Area number 4, near trend lines. A lot of retail traders use trend lines just like support and resistance. Whenever price follows a trend line, there are stop-loss orders sitting on the other side of that trend line. Like, if a trend line is acting as support in an uptrend, buyers place their stop-loss below the trend line. This creates sell-side liquidity right below the trend line. The market very often temporarily breaks through this trend line to hit these stop-losses and then continues in its original trend direction. That's exactly why taking an entry right on a trendline breakout is extremely risky. Area number 5, near psychological levels. In the market, round numbers like 1,000, 500, 800, and 200. Retail traders place a massive number of trade entries around these psychological numbers. Because these numbers are easy to remember, and most traders place their orders at these levels. For example, if a stock is at the 2000 level, a lot of traders think it's an important level and that the market could bounce from here. So they buy there and place their stop loss below this level. Because of the huge amount of liquidity that gets generated near these levels, it becomes extremely easy for operators to trap retail traders by showing fake breakouts to grab this liquidity. So whenever you're looking at a chart, along with reading the candlesticks, you also need to figure out which area has the most active buyers and sellers at that moment, because at the end of the day, it's buyers and sellers who drive the market. Chapter 3. What is buy-side and sell-side liquidity? This concept can be a bit confusing for beginners at first, so pay close attention. Buy-side liquidity. The liquidity that sits above a certain level on the chart is called buy-side liquidity. Whenever sellers enter short trades in the market, their stop losses are placed above, on the upside. Now, these stop-loss orders are actually buying orders, because when a seller's stop-loss gets hit, the system automatically executes a buy order to close their short position. That's why the stop-losses sitting above swing highs, equal highs, and resistance levels all create buy-side liquidity. For example, let's say the market is heading down and a swing high has formed on the chart. A lot of sellers would have looked at this swing high and thought the market is going to take resistance here and head back down. So they entered short trades at this level and placed their stop loss above this swing high. Now, all of these sellers' stop losses are buy orders. That means a huge number of buy orders are pending right above this swing high. This is what we call buy-side liquidity. Now, whenever operators need to sell, they need retail buyers. So they push the market up, hit all these sellers' stop losses, which triggers those buy orders, and the operators get the buyers they need to execute their sell orders. Sell-side liquidity. The liquidity that sits below on the chart is called sell-side liquidity. Whenever buyers enter long trades, their stop losses are placed below, on the downside. Now, these stop-loss orders are actually selling orders, because when a stop-loss gets hit, a sell order executes to close the buyer's long position. That's why the stop-losses sitting below swing lows, equal lows, and support levels all create sell-side liquidity. For example, let's say the market is in an uptrend and price has made a fresh swing low. A lot of retail buyers would have placed their stop losses below this swing low when entering their long trades. Now, all of these buyers' stop losses are sell orders. That means a large number of sell orders are pending right below this swing low. This is what we call sell-side liquidity. When operators need to buy, they need retail sellers. So they push the market down, hit all these buyers' stop losses, which triggers those sell orders, and the operators get the sellers they need to execute their buy orders. It's the exact opposite process of buy-side liquidity. Operators in the market always look at which side of the chart has the most liquidity, and then they move the market in that direction to grab that liquidity. This way, retail traders' stop losses get hit, and operators get the liquidity they need to execute their massive orders. Chapter 4. What is internal liquidity and external liquidity? The liquidity that sits near the extreme top and bottom points of any chart is called external liquidity. When you zoom out a bit on the chart, the major swing high at the very top and the major swing low at the very bottom. The stop-loss orders sitting around these points create external liquidity. For example, if the market is trading in a range, then above the range, there's a major swing high with sellers' stop losses above it. That's buy-side external liquidity. And below the range, there's a major swing low with buyers' stop losses below it. That acts as sell-side external liquidity. External liquidity is important because whenever external liquidity gets swept or grabbed in the market, we see big moves. Because that's where the largest number of stop-loss orders are sitting. Internal liquidity, between the two extreme points, meaning between the major swing high and major swing low, the smaller swing highs and swing lows that form, the liquidity visible around them on the chart is called internal liquidity. This basically forms around smaller price action patterns, minor support and resistance levels, and minor swing points inside the market where retail traders place their stop losses. Now, let's understand how these two are related to each other with a step-by-step chart example. Here, the market is trading in a range. At the top, near the range high, there's buy-side external liquidity, and at the bottom, near the range low, there's sell-side external liquidity. Now, if the market wants to go down and grab the sell-side external liquidity, operators first need to create volatility in the market so that retail traders jump in and generate liquidity. So operators first push the price up toward the range high and show a fake breakout. Seeing this breakout, a lot of retail traders think the market is about to go up, and they enter long trades. These retail traders have their stop losses below, which generates internal liquidity inside the range. Now, operators hit these stop losses and drive the price sharply downward, grabbing the sell-side external liquidity below the range low as well. What this means is that operators first showed a fake breakout on the upside to create internal liquidity. Then, they swept the upside external liquidity, and after that, they grabbed the sell-side external liquidity on the downside. This whole process happened step by step. That's why, if there's an external liquidity area near an internal liquidity area on the chart, you should always avoid taking trades in that situation. Because in that zone, operators can target liquidity on both sides, which significantly increases the chances of your stop loss getting hit. Chapter 5. What is a liquidity pool? When there are stop-loss orders sitting near a single level on the chart, we simply call that liquidity. But when there's a large amount of liquidity sitting at multiple different levels in the same direction on the chart, in smart money concepts, that's called a liquidity pool. For example, here on this chart, the market is in an uptrend and price is making higher highs and higher lows. Now, near every swing low, buyers have entered long trades. Below the first swing low, there are some stop losses. Below the second swing low, there are more stop losses. Below the third swing low, there are stop losses too. Now, all of these stop losses are sell-side orders, and because there's a massive amount of liquidity at multiple levels in the same direction, the downside, that's why it's called a liquidity pool. Operators also prefer to move the market in the direction where a liquidity pool exists on the chart, because that's where they get the opportunity to execute a massive number of orders all at once. Now let's also understand how this concept works practically. On the chart, there's just one swing high on the upside with limited buy-side liquidity. But on the downside, there are 3 or 4 swing lows with a large amount of sell-side liquidity. That means a big sell-side liquidity pool has formed on the downside of the chart. In this situation, operators will push the market down to grab this entire liquidity pool. Because compared to the upside, the downside gives them the chance to execute a much larger number of orders. Because of this, you need to identify which side of the chart has a larger liquidity pool available. Whichever side has the bigger liquidity pool, the market most often makes a big move in that direction, so you should always try to trade in the direction of the liquidity pool, not against it. Chapter 6. Liquidity Sweep versus Liquidity Grab. Now, understanding the difference between a liquidity sweep and a liquidity grab is also very important, because a lot of beginner traders think these are the same thing, but they're actually quite different from each other. Knowing the difference is essential for your trading. Liquidity sweep. When the market temporarily breaks a level, hits the stop losses sitting there, and then reverses back in its original trend direction, that's called a liquidity sweep, meaning price only breaks a level to clear out the liquidity and then reverses right back. While trading in the live market, you've probably noticed many times that the market moves forward, building a bullish structure like this on the chart. Higher highs and higher lows are forming, which makes it clear that buyers are strong right now. So most retail traders would have entered long trades in the direction of the price action, and their stop losses are sitting below these swing lows. But suddenly, at one point, price drops sharply and breaks down below the recent swing low. Seeing this, a lot of retail traders think a bearish trend is starting now, and they enter short trades. But then price forms some kind of candlestick pattern near the breaking point and resumes its old uptrend. This traps a whole bunch of retail traders. I'm pretty sure a lot of you have experienced this in your own trading. What happened here is that the market hit the stop losses of all the retail traders who were sitting in long trades near that recent swing low, sweeping the liquidity in that area. And on top of that, the fresh short traders who jumped in after seeing the breakdown also got trapped when price shot back up. This is what we call a liquidity sweep. Price cleared the liquidity at just one level and came right back. But why do operators do this? Because at higher levels, retail traders' interest in buying starts to fade a bit, and operators can't find enough liquidity from retail traders to execute their buy-side orders. So, to create volatility in the market, they deliberately push price below the old swing low. This gets fresh retail traders to enter short trades with their stop losses placed above, which generates a large amount of buy-side liquidity on the chart. Operators sweep this liquidity, and price shoots back up sharply in the direction of its original trend. Liquidity grab or liquidity run. Whenever the market moves in one direction without stopping, grabbing liquidity at one level after another, that's called a liquidity grab or liquidity run. Here, price keeps going in one direction, hitting all the stop losses along the way. For example, in a bullish trend, price forms higher lows and gives buyers the opportunity to enter long trades near each swing low. This generates a large amount of stop-loss liquidity at each level. Now, price first breaks one swing low and sweeps the liquidity there. But after that, instead of going back up, price continues downward, hitting the stop losses at every level, one after another. It hits the first swing low's stop losses, then the next one below that, then the one even further below. Since price is going straight down in one direction without stopping, grabbing liquidity as it goes, that's why we call it a liquidity grab or a liquidity run. Sometimes, after breaking its swing low, the market shoots straight up instead of going lower. That's also a form of liquidity run. But 8 out of 10 times, price behaves like the first example. Now for the most important part, how you can use the liquidity concept to actually improve your trading. Keep these important points in mind at all times. Point number 1. Whenever you look at a chart, the first thing you should do is identify which side has the most liquidity. Is it more on the buy side above or the sell side below? To do this, mark the swing highs and swing lows on the chart and figure out which side has more potential pending stop-loss orders. For example, if there are 3 or 4 swing lows below on the chart but only one swing high above, then the sell side has a bigger liquidity pool. This means the market could make a big move to the downside. Whichever side has the bigger liquidity pool, the market most often makes a big move in that direction. So always try to trade in the direction of the liquidity pool. Point number 2. Whenever the market breaks an important level for the first time, avoid jumping into a trade in that direction right away. Because most of the time, the first breakout or breakdown you see on the chart is more likely to be a liquidity sweep, where operators are trying to hit retail traders' stop losses and knock them out of the market. For example, if the market breaks a support level for the first time, don't immediately enter a short trade. First, see whether price is sustaining below the support level or coming right back up. If price starts coming back up, it was a liquidity sweep and you shouldn't have entered a short trade there. So after a breakout, wait for at least 1 or 2 confirmation candles to form in that direction on the chart. Point number 3. Before entering a trade, always check whether a liquidity sweep has already happened on the chart. Because operators always try at least once to knock retail traders out of their trades before moving the market in their desired direction. For example, if the market is in an uptrend and price has gone down once to sweep the sell-side liquidity, that's a signal that the market might now go up to grab the buy-side liquidity. So, if price has swept liquidity on one side, the market may now move to grab liquidity on the other side, and you can trade in that direction with a tight stop-loss. Point number 4. In a liquidity run, price most often tries to grab the external liquidity on the chart. This means if price is moving non-stop in one direction, its target is the external liquidity area on the chart. So after entering a trade, you can hold your profit target all the way to the external liquidity area using a trailing stop loss. This gives you a great risk-to-reward ratio. But remember, using a trailing stop loss is really important here so that even if price reverses in the middle, some of your profit stays safe. Point number 5. If there's an external liquidity area near an internal liquidity area on the chart, you should always avoid taking trades in that situation. Because in that zone, operators can target liquidity on both sides, which makes the chances of your stop loss getting hit the highest. Point number 6. Whenever a big, strong momentum candle forms on the chart, one that's way larger than the surrounding candles, you should always avoid entering a trade in that candle's direction right after it forms. Because these kinds of candles are created by operators to increase volatility and trap retail traders. This is a pro tip. Always keep it in mind. Whenever price makes big candles like this from a certain level, moving up or down, where the next candle opens inside the previous candle's body and price moves forward slowly with small candles. 8 out of 10 times, retail traders are behind this kind of move. But if you see really large candles on the chart and prices shooting forward with massive momentum, that's the operators at work. So entering right after this kind of momentum candle is the easiest way for retail traders to get trapped. Even after understanding the liquidity concept, a lot of traders make some common mistakes, and these mistakes cause them to lose money over and over again. Let's go through them in detail so you can avoid them. Mistake number 1. A lot of traders, after learning the liquidity concept, start seeing liquidity everywhere on the chart. Every little swing, high and low, suddenly looks like liquidity to them. But that approach is wrong. You should only focus on areas where a large number of retail traders' stop losses are likely sitting. These are areas where price has reacted multiple times, where equal highs or lows have formed, where there are obvious support and resistance levels. Learn to ignore liquidity at small, insignificant levels. Seeing liquidity everywhere can lead you straight into overtrading. Mistake number 2. Some traders, even after a liquidity sweep has happened, still take trades against the direction of the sweep. This is a huge mistake. For example, if the market has swept the sell-side liquidity below and started moving up, that means operators have cleared the downside liquidity and now the market wants to go up. In this situation, you should only be looking for trades to the upside, not the downside. But a lot of traders still think the market will go back down after the sweep and they enter short trades, which leads to their stop loss getting hit. So always remember, after a liquidity sweep, the market most often moves in the opposite direction of the sweep. Mistake number 3. A lot of traders only look at liquidity on a single time frame, like they only mark liquidity areas on the 5-minute chart. But if you want better results, mark liquidity areas on higher time frames like the 15-minute or hourly chart, and then take trade entries on lower time frames like the 5-minute or 1-minute chart. Because liquidity that forms on higher time frames is way more powerful. There are much larger numbers of stop-loss orders sitting there. So always give higher time frame liquidity more priority over lower time frame liquidity. This will give you a much clearer picture of which direction the market might move today. Mistake number 4. Some traders, after learning the liquidity concept, start ignoring everything else. They begin taking trades based solely on liquidity. But the liquidity concept doesn't work in isolation. It's one piece of the puzzle, not the entire puzzle. You need to combine it with market structure, order blocks, fair value gaps, and premium discount zones. Look, chart reading is an art. And if you want to master this art, you've got to practice as much as possible. Everything we learned today, go back test it on your charts, because without practice, you can't truly master any concept. If you found this video helpful, don't forget to like the video and subscribe to the channel. Thanks for watching.